Hey everyone, so in this video I'm going to be talking about Sea Limited stock and a couple of red flags that I came across in their last earnings report, which actually eventually led me to closing my position in this company. My thesis, when I originally invested in the stock has technically been broken here. I'm going to explain all of that in this video. And normally when you see this, a 20% green day on a stock, it's a positive sign for the stock, right? Investors are happy. Things look good, and in this case, all of this was fueled by this headline here that non-GAAP EPS for Sea Limited was 72 cents, which showed profitability and smashed estimates which were predicting another loss for the company. And then again, they had a double beat. On revenue, they beat massively with over $400 million. Now, if you stop there, things look amazing for Sea Limited. But if you dig a little bit deeper, there are a few things which can be concerning if you are a shareholder of this company, and you should be aware of these things if you plan to continue holding the stock. These are fundamental issues, in my opinion, that I'm going to be talking about in this video. So stick around. I think you'll learn a thing or two. And at worst, even if you're not invested in the stock, you'll kind of understand how to just kind of peel back the onion a bit and just analyze investor decks and just financial statements a little bit beyond what the headlines say. So like I said, I no longer own this stock. It was a stock in my speculative portfolio, so it made up a very small portion of my portfolio, but it was still an investment that I had. And I built this out throughout 2022, but as of this video, I don't own the stock anymore. So let's start kind of at the beginning. Let's ask the big elephant in the room question. How did they turn a profit this quarter? Super simple, they cut expenses. Specifically, if you look here, they cut their sales and marketing expenses significantly, going down from $1.2 billion last year to $473 million this year. And this cut in spending led them to show a profit this quarter. Now you gotta ask yourself the question, is this sustainable? Is this repeatable? Can they keep doing this quarter after quarter to continue growing profitability? Well, here's the thing. If Sea Limited wants to be a hyper growth stock like it was a couple of years ago, then in my opinion, no, you need to keep advertising. You need to keep getting out there, selling your product, because that's what leads to higher growth typically. You gotta also remember, in this space here that Sea is competing with, it's fierce. There's massive giants here with deeper pockets that can spend more to acquire customers. So it's not like they can cut back spending and just expect growth to continue growing strongly. There probably will be some consequences to this move. It's still too early right now to see what the effects are of this, but in due time, I think we will see it. Maybe it ends up being a good move for them and they still continue their growth despite these cuts in spending. Or maybe, which I think is a more possible scenario, they'll actually suffer from this in a few quarters because now they just aren't getting their word out anymore of why consumers should use their platform. And all of this really circles around, in my opinion, one of the biggest issues here with Sea stock, at least for me with my thesis, and that's around the growth or lack of growth for this company. Growth was only 7% year over year here for the company, which in most cases isn't a huge deal. But it was a huge part of why I bought the stock, guys. When I first bought this, I expected to see strong, at least double-digit growth for the foreseeable future. Here's an example. Looking back at 2022, this is what Sea reported. Over 100% year-over-year growth for revenue and gross profits, which was absolutely mind-boggling. And of course, I wasn't going to sit here and expect to see 100% growth continuous year after year after year. That's obviously going to slow down. It's not sustainable as the company gets larger. However, to go from 100% to 7% in a year, that is definitely cause for concern. Now I know, we had rising interest rates last year. We have a strong US dollar, which affects international companies like Sea Limited. And we just had consumer spend, start to contract. But all in all, for a company that saw such strong growth in 2021, it doesn't just flip like that, in my opinion, from one year to the next. It's a gradual decline at worst. And it kind of got me thinking, hey, is the growth here done for this company? Are they going to acquire new customers? Are they going to grow in the next, say, year or two? If we drop from 100 to 7%, what comes next year? Are we going to go into negative growth? These are all questions that were kind of running through my head. Now, another huge red flag, guys, was their gaming business, Garena, and This was a huge part of the thesis again. This was kind of their cash cow. This was part of the business that was really fueling them to earn a ton of money and then spend it in things like Shopee and other segments they want to grow over time. But you can see here that bookings and users playing games on this platform were down sharply. This is not just a little bit of a decline here. This is a sharp decline, which tells me that consumers are losing interest with their games, and thus this prevents that cash cow segment from fueling future growth. But the worst part about this is how management tried to mask these results. They showed quarter-over-quarter results when the rest of their slide deck shows year-over-year. And that's because quarter-over-quarter shows that the impact isn't as bad. But if you look at year-over-year, it is a huge drop. This is the metric that we should be looking at, not quarter-over-quarter. So in my opinion, shame on management here for trying to deceive investors. When management does these sort of tricks, marketing tricks, it kind of makes you question, hey, what else might I have missed? What else do I have to go and kind of double check again to make sure that I actually saw it correctly, right? Because a lot of people may have looked at that slide and said, hey, that looks pretty good for year-over-year, not too bad. But then you look closely at the numbers, they're actually showing quarter-over-quarter numbers, and again, not a great place to be if you're an investor that's trusting management. So this, of course, was a huge reason, again, as to why I decided to close my position. If management can't be trusted, I'm not interested in the company. Anyways, just to show you how bad the drop actually was on a year-over-year basis, look at this. Operating income for this segment year-over-year got cut in half, and adjusted EBITDA was down more than half. This is a significant slowdown. Now, obviously, the stock price has reflected this, going from like $3.50 per share to like $50 per share in the span of a year. So it's not like this is all new news to you guys. But for this company to get back to its former glory, the gaming platform really needs to step up and start growing once again. And as of latest results, it doesn't look like it's going to happen anytime soon. And we could see more significant drops in users and engagement and revenue and, of course, profits in coming quarters. Now, some might say at this point, Nick, you're missing the whole idea, the investment of Sea Limited. It's not about their gaming. It's about Shopee. Okay, so let's talk about Shopee. Well, everyone says it grew massively, and they're right. Revenue for Shopee was up 44%, and it turned adjusted EBITDA positive, which is a huge swing from the loss last year that it saw. Looks great at first glance, right? Well, let's peel back the onion once again. Gross orders actually fell year-over-year by 12%, and GMV, gross merchandise volume, was also down year-over-year. But how? How is this possible? How does this make any sense? How could they grow revenues 44%, but have less orders on the platform and less total product sold on the platform? Easy. They just charge higher fees to merchants. That's how they made their money this time. And Sea has the power to do that. It obviously shows the moat that they have here, at least for this part of it. Sellers are willing to pay additional fees here to stick on their platform and continue selling their product. But again, you got to ask yourself this question: how many times can Sea really raise prices? I don't think they can do this every quarter because they're just not sustainable. Maybe they could do this every year. But again, eventually it's going to get to a point where competitors, Amazon and others, can come in at a lower cost to steer those sellers away. And again, that'll be bad for Sea. So while they can do this right now, I think there is a ceiling to this, and that could be, a huge negative for them in the future. So keep an eye on that. Keep in mind that, for growth companies in the e-com space, you want to see numbers like a GMV. You want to see numbers like total orders. You want to see these things grow over time, right? So it's much appreciated that Sea actually shares these metrics, unlike a lot of other companies like Amazon. However, on the latest conference call, management did say that they will stop disclosing GMV and orders because it's not a target they focus on. Whoa. Red flag once again, in my opinion. If you choose to disclose these numbers in good times, like they did in 2020, 2021, right? Those are boom times. You should, have the ethic, the morality here to actually show these numbers in bad times as well. Give investors the full picture. Don't try to massage numbers, show quarter over quarter when you should show year over year. Don't try to hide things to make yourself look better. Give us the facts. If the company is actually struggling on certain aspects that you think investors are going to care about, which obviously they will, show it. Be transparent. This management team, once again, is clearly telling me that the business is probably going to keep slowing in the coming months and years potentially. And they don't want to show those metrics anymore because they're going to look bad. So they're going to show other metrics which are industry standard, even though during the good times they did show these metrics which were not industry standard, and they benefited massively from that with their stock price booming. Remember, Sea also did a massive round of dilution when the stock was much higher. In hindsight, smart move for them because that put them in a much healthier position to withstand this huge slowdown that they saw. But in my opinion, it's kind of slimy here for management, not for taking advantage of the boom and, issuing shares at a high, but for completely changing what they show investors going forward. And in my experience from other investments that I've seen that have changed what they show investors going forward to make things look better, it rarely works out for the best. So finally, the last thing I want to talk about here is the cash balance of Sea Limited. So up until this point, they've been burning a ton of cash. Now they showed a profit this past quarter. If it's sustainable, it's not really too big of an issue. However, if you look at the cash balance right now, you can see it's been dwindling. It's slowing down how much they bleed, and it could actually start increasing if they generate free cash flow. But it is something to keep an eye on, because if that cash balance keeps dwindling, they will most likely have to issue shares once again, which means you get diluted once again. So I know that was a lot to digest, guys, and I appreciate you sticking around to this point in the video. And, if it's not clear by now, you can tell that I'm not too happy with management, not too happy with the growth slowing down, not too happy with the fact that, while they grew Shopee, the number of orders that they had and GMV was down year over year. It doesn't tell me that this product is sticky enough for consumers to go in and use it. So there's a lot of stuff really that doesn't sit well with me, and I decided, hey, there's better places out there for my money. Amazon is a huge example of this. They're also down massively, but they're a well-run company that I can actually trust the management with. So I'd rather take capital from here and put it in companies like those. The 20% pop that we saw after earnings was a great opportunity for me to exit. I did still take a loss on the position, in full disclosure here, but it was a small position in my portfolio, like 1% or so. So it wasn't really much of a hit here despite the losses. If you want to look at more international plays, consider looking into companies like Mercado Libre or even Coupang, which I'll cover in a future video very soon, because those companies I think have more trustable management teams, and they are executing better as well, in my opinion. Anyways, guys, this was informative. Let me know in the comments down below. Let me know if you own Sea stock. Love to hear your thoughts as always. But anyways, thank you so much for watching. Don't forget to rest positively, and I'll see you in the next one. Peace.